Okay, so you want to open a gym. Find a unit, fill it with treadmills, and watch the direct debits roll in every month. That is the plan in your head, and it is not a bad one. Walk into any gym in Britain on a weekday evening, and it looks like one of the easiest businesses in the world. Every treadmill taken, a queue for the squat rack, someone waiting for a locker. You watch that scene and you think, this place must be printing money. More people, more memberships, more money. Simple. Here is the problem. You are looking at the 1 hour of the day that lies to you the most. The truth is that a gym is not really a fitness business. It is a subscription business that happens to have dumbbells in it. And the moment you understand that difference, everything about how a British gym makes money and how it quietly loses money starts to make sense. Let us start with what it actually costs to get in the door, because the price tag is a lot more complicated than a lease and some equipment. There is not one type of gym in the UK. There are several, and each one is really a different business wearing the same tracksuit. At the bottom end, you have the budget chains, the £10 to £25 a month operators like the ones that have expanded rapidly across British high streets and retail parks, filling a former supermarket unit with thousands of members and making their money purely on volume. One location like this can hold 5,000 to 8,000 members and still only need a skeleton staff to run it. Above that sits the traditional mid-market gym, the kind with a weight floor, some cardio machines, and a timetable of group classes, usually charging somewhere between £30 and £60 a month. Above that, the premium health club operators, the kind with a pool, a spa, and a members' lounge, charging over £100 a month and selling considerably less of a gym and more of a lifestyle. Then there are the boutique studios, small rooms sometimes under 2,000 square feet, built entirely around one style of class, charging anywhere from £50 to £150 a month, or selling class packs instead of memberships. And then the small, brutal category, the one-to-one personal training studio, sometimes as small as 500 square feet, that does not sell memberships at all. It sells your time with a coach. Each of these is a different bet on the same underlying question. Do you make your money from a huge number of people paying a little, or a small number of people paying a lot? That single decision shapes every other number in the business. Now here is where the naive mental model starts to break down. You think the expensive part is the equipment. It is not. The expensive part is turning an empty box of a building into something that can legally and safely hold sweating human bodies. A commercial landlord in the UK will typically ask for 3 to 6 months of rent up front as a deposit before you have done a single day of fit-out work. Then comes the build-out. Rubber flooring that can absorb the impact of a dropped barbell without cracking the slab underneath costs £8,000 to £30,000. Changing rooms and showers need moisture-resistant materials and proper drainage. Another £10,000 to £40,000. Mirrors alone, floor to ceiling, can run £2,000 to £10,000 once installed. And then there is the part almost nobody in Britain budgets for correctly: ventilation. Building regulations require a proper mechanical ventilation system for a room full of people generating heat and moisture for hours at a time. And getting that wrong is not just uncomfortable, it can fail an inspection outright. A full commercial ventilation upgrade for a mid-sized gym floor can cost anywhere from £10,000 to £40,000 before a single membership has been sold. Add up the deposit, the fit-out, the licenses, the insurance, the opening marketing push, and a cash reserve to survive the slow early months. And even a modest mid-sized British gym can require £200,000 to over £800,000 just to unlock the front door. So far, so good. Now, let us talk about what can go wrong. Equipment is the next trap, and it is a bigger one than people expect. A single commercial-grade treadmill in the UK costs between £1,000 to £506,000. A gym needs 6 to 12 of them just for a baseline cardio section. Selectorized strength machines run £800 to £4,000 each, and a proper gym floor needs 12 to 20 of them. Add power racks, dumbbells, benches, and accessories, and the equipment bill alone for a mid-sized gym can land anywhere between £30,000 and £200,000. Here is the decision that trips people up. Do you buy the equipment outright, or do you lease it? Buying feels safer. You own it. It is an asset. No monthly lease bill hanging over your head. But buying drains your cash reserves right when you need them most, in those first uncertain months before members show up in numbers, and treadmills do not last forever. Heavy daily use wears a machine down in a way home use never would. Leasing sounds like the smart move. Small monthly payments keep your cash free, and you can upgrade the kit every few years so it never looks dated. Here is the catch. Equipment finance in the UK typically carries an interest rate that can push the total cost meaningfully above the equipment's actual value over the life of the agreement. And the lease does not care whether your gym is doing well. If membership dries up and you have to close the doors, the payments do not stop with you. They are a contractual obligation that follows you out. Neither option is wrong, but whichever one you pick, you have locked in a large fixed cost that has to be paid every single month, regardless of how many people walk through your door that day. Now, location. This is the decision most first-time owners get wrong, because they think a good location just means somewhere with a lot of people nearby. It is more specific than that. Roughly 80% of a gym's membership base in the UK comes from within a 10 to 15-minute drive or walk of the building. That is it. That is your entire addressable market. Not the city, not the wider borough, a genuinely small radius. Inside that radius, the income level of the local population has to match your pricing. A premium club charging over £100 a month cannot survive in a catchment area built around a budget income base, no matter how nice the equipment is. And a high street unit in a major British city can cost dramatically more per square foot per year in rent than a retail park unit on the edge of a smaller town. Pick the wrong side of that gap, and you have committed to a rent bill that requires a membership base your local area simply cannot supply. Now we get to the part of this business that actually explains everything else: the membership itself. Picture a coin flip. Except instead of heads or tails, imagine every person who signs up for a gym falls into one of two futures. In one future, they show up 3 times a week, every week for a year. In the other, they show up twice in January, feel good about themselves, and then never come back, while still paying every month by direct debit. Which of those two members is more valuable to the gym? It is the second one. And this is the single most important idea in the entire fitness business. Let us slow down and actually do the maths. The person who comes 3 times a week uses hot water for showers, puts wear on the treadmill belt, needs towels laundered if the gym provides them, and takes up floor space during the exact hour the gym is most crowded, which can annoy other members and push them toward canceling. Every visit costs the gym a small amount of real money and a small amount of real capacity. The person who signed up in January and never came back costs the gym almost nothing. No hot water, no wear on the equipment, no crowding, while their monthly direct debit keeps arriving like clockwork, and nearly every pound of that payment flows straight to the bottom line. Industry surveys in the UK consistently suggest that a large share of gym members rarely or never use the gym they are paying for. And the majority of the revenue base of a typical budget gym is coming from people who are simply not exercising there. This is not an accident. It is the business model. Think about the building itself. A gym with 6,000 or more members could never physically fit even a fifth of those people on the floor at once. Fire safety regulations would not allow it, and the equipment would not be enough. A typical gym floor might be legally capped at somewhere around 200 to 300 people at a time. If even 10% of a 7,000-member gym showed up simultaneously, you would have 700 people trying to fit into a room built for maybe 250. And that would breach fire regulations within minutes. So the gym is not selling access to a room. It is selling a statistical bet that most of the people who buy a membership will not use it at the same time, and a large chunk of them will not use it at all. The building only has to be big enough for the fraction of members who actually show up, not the total number who pay. This is why gyms do not secretly want every member to become a daily regular. A gym full of daily regulars would need a much bigger, much more expensive building with much higher utility bills to serve the exact same number of paying customers. The forgotten membership, the one sitting unused on someone's bank statement, is quietly one of the most profitable customers a gym can have. There is a seasonal wrinkle to this whole picture too, and it shapes the entire financial calendar of a British gym. A significant share of annual gym sign-ups happen in January, driven by New Year's resolutions, and gyms lean into this hard, discounted joining fees, low-cost trial offers, a burst of advertising spend concentrated into just a few weeks. That single month can hand an owner a large injection of upfront cash and a wave of new monthly billing. But the same wave that comes in fast goes out almost as fast. A substantial proportion of new members stop attending within 6 months of signing up, and of the people who join specifically as a January resolution, the vast majority have quietly stopped showing up by the time summer arrives. February tends to be the highest risk month of all, the point where the initial burst of motivation fades before a real habit has formed. Experienced owners do not panic about this. They plan their entire cash flow around it, using the January surge to build a reserve that carries them through the quieter summer months when new sign-ups slow down. The owners who get caught off guard are the ones who spend that January windfall as if it were a permanent, ongoing level of revenue, rather than the seasonal spike it actually is. There is also a structural choice sitting underneath all of this: whether to build an independent gym from the ground up or buy into an established franchise. A franchise gives you an already known brand name, a proven layout, standardized software, and often better pricing on equipment through corporate purchasing deals. That is valuable, especially for a first-time owner. But it is not free. Franchise agreements typically require an upfront fee running into the tens of thousands of pounds, an ongoing royalty of around 5 to 10% of gross revenue paid back to the parent company every month, and often an additional contribution into a shared national marketing fund. An independent owner keeps every pound of profit the business generates. A franchise owner is permanently sharing a slice of the top line in exchange for the brand recognition and support system, which can be worth it. But only if the extra membership volume that brand name attracts is large enough to cover what you are handing back every month. Now, here is where the psychology becomes just as important as the maths. Why do people keep paying for something they do not use? Part of it is optimism at the moment of signing up. The membership feels like a promise to a future version of yourself. Part of it is what economists call a commitment device. Paying for the gym is meant to be the thing that forces you to go, and part of it is pure inertia. Canceling requires admitting the plan did not work, and for a monthly fee of 10 to 30 pounds, most people would rather quietly keep paying than confront that. And gyms know this. which is why the process of leaving a gym in Britain is almost never as easy as the process of joining one. Many membership contracts require written notice, sometimes a full calendar month or more in advance, which guarantees the gym collects at least one more month of dues, even after you have decided to leave. This friction has not gone unnoticed by regulators. The Competition and Markets Authority has previously investigated unfair contract terms in the UK gym sector, specifically around automatic renewal clauses and lengthy notice periods that make cancellation deliberately difficult. Keep this in mind, because it tells you something important about the business you are considering. If a gym's survival depended on happy, engaged, frequently attending members, it would not need to make canceling this hard. The fact that cancellation friction is such a core part of gym operations tells you the business already knows a large share of its revenue comes from people who wish they were not paying. Before we get to what can go wrong at scale, there is a second layer of hidden cost that catches almost every first-time British gym owner off guard. And it has nothing to do with treadmills. It is the music. Playing background music in a UK commercial space requires a license, and there are two separate organizations you typically need to pay. One representing the rights of composers and songwriters, and another representing the rights of performers and recording labels. Skipping this is not a small risk. These organizations do send representatives out to check premises, and the penalties for playing unlicensed music in a commercial gym can run into thousands of pounds. A gym owner who assumes a personal streaming subscription is good enough for the sound system has quietly taken on a legal risk worth far more than the proper license would have ever cost. Add to that the ongoing bill for equipment repair and replacement, which for a mid-sized British gym typically runs somewhere between £800 and £2,500 a month, and utility bills for constant ventilation, lighting, and hot water, which can run between £800 and £5,000 a month depending on the size of the site. None of these numbers are dramatic on their own. Stacked together month after month, they quietly eat into the exact margin the owner was counting on. Now let us talk about whether a gym built entirely on this quiet subscription model can actually survive at scale. Because the honest answer is sometimes not. Fitness First, once one of the largest and most recognizable gym chains on British high streets, went through a painful debt restructuring in the early 2010s after expanding aggressively on borrowed money, and had to sell off large parts of its UK estate as a result. The company did not collapse because people stopped wanting to work out. It struggled because the debt taken on to fund rapid expansion outpaced the actual cash the gyms were generating month to month. Here is the structural observation, because it is really the point of the whole story. A gym with thousands of members and full car parks can still be one bad debt structure away from serious financial trouble. The visible crowd on the gym floor tells you nothing about whether the underlying financial structure can hold. So how does a British gym actually make money in plain mechanical terms once it is past all of this? The core engine is simple. Monthly dues times number of members, minus fixed costs. If a gym has fixed monthly operating costs, rent, payroll, equipment finance, utilities, insurance, software of around £25,000, and it charges an average of £35 a month per member, it needs somewhere around 715 paying members just to break even. Below that number, the gym is losing money every month. Above it, additional members are almost pure profit because, remember, the marginal cost of an inactive member is close to zero. That is the good news. Here's the volatility that comes right after it. New gyms typically do not reach that break-even membership count on day one. It can take 12 to 18 months of accumulating members before a facility crosses into profitability. And every one of those months burns through the working capital reserve the owners set aside before opening. If the pre-opening sales push is weak or a competitor opens nearby during that window, the runway can run out before the gym ever turns a profit. And membership is not a stable, permanently growing number. Annual member churn in the UK gym industry typically sits somewhere around 30 to 40%, which means a gym has to replace a significant chunk of its entire membership base every single year just to stay exactly where it started. That is not growth. That is running in place. This is where a second revenue stream becomes essential. And it is the one with genuinely strong economics: personal training. A trainer working one-to-one can only train so many people, at a typical rate of around 40 to 60 pounds per session, capped at a realistic number of sessions a week to avoid burning the trainer out. A single trainer working purely one-to-one tops out at a hard ceiling of annual revenue, because you cannot add more hours in a day. The way around that ceiling is training multiple people at once. A coach running a small group session with 4 clients, each paying £20, brings in £80 for that single hour, roughly double the rate of one-to-one work, while each client individually pays less than they would for private coaching. Of course, the gym does not keep all of that. Trainers on payroll or self-employed arrangements typically take a commission of 30 to 50% of what they bring in. Still, across a full roster of clients, personal training tends to be far more profitable per hour than a basic membership ever could be. One dedicated personal training client can be worth dozens of members who barely use their card. Now let us put all of this together and look at what actually happens over a full year. Because this is where the two very different versions of this business reveal themselves. In the optimistic scenario, you have picked the right catchment area, hit your break-even membership count on schedule, kept churn on the low end of normal, and built a healthy personal training program alongside your base of members. Under those conditions, a mid-sized independent British gym can generate somewhere between £400,000 and £1.5 million a year in revenue, with a net profit margin of 10 to 20%, translating to an owner's take-home somewhere between £50,000 and £150,000 a year. A genuinely solid outcome for the work and capital involved. In the realistic scenario, 2 or 3 things go wrong that are not exotic at all. They are the normal risks of this exact business. Churn runs at the high end of normal instead of the low end. A new budget chain opens nearby and pulls price-sensitive members away with a cheaper monthly rate. Equipment starts needing more frequent repairs than expected, adding another £800 to £2,000 a month to overheads. Under those conditions, that same gym can slide from a comfortable double-digit profit margin into a single-digit margin, or into an outright loss during a slow season, even while the car park outside still looks reasonably full most evenings. And almost none of that swing shows up as a dramatic visible event. No fire, no scandal, just a slightly higher cancellation rate, a slightly slower membership ramp, and a slightly heavier repair bill compounding quietly, month after month, until the number at the bottom of the spreadsheet looks nothing like the plan. So, if you do decide to open a gym in Britain, remember the one thing that actually determines whether you succeed. It was never really about how many people you can get to sign up. It is about how well you can survive on the people who stop showing up. If this kind of breakdown helps you see a business differently, that is exactly what this channel is built around. Subscribe to Money Framework British for more deep dives into how everyday businesses really make their money behind the scenes. And turn on notifications so you never miss the